Good Friday morning and welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. I know you want a hot take from me on the jobs report now that we see the economy only created 50,000 jobs in December, below forecast for 70,000. The number of jobs for October and November revised lower by 76,000. So here is that hot take. Think of it as more of a worthy reminder to all of you out there. Nothing lasts forever in markets, especially feel-good vibes. And if the market rally to kick off 2026 is to be tested this month, it's likely to come from stocks being priced for perfection, and perfection not happening. The forward price to earnings ratio for the S&P 500 is 22 times, well above the 10-year average of 18.7 times. This stuff matters, friends. Stocks are almost as richly valued as when they hit a peak in early January 2022. What followed was the start of a 9-month-long bear market. The benchmark index plunged about 19%. Wall Street is pricing in a big year for corporate earnings on a view mostly everything from the economy to AI productivity to geopolitics going absolutely awesome. For the year, earnings are being modeled to grow a hearty 15%. So what could spook the markets? Pick your poison. The jobs report wasn't great. A stretch of more reports like this could begin to undercut the optimism on corporate earnings in the first half of the year. And moving forward, there's also no guarantee that the Fed cuts interest rates several times in the front part of the year, as consensus expects. How could they justify cutting again with inflation cooling and the stock market near records? Like, what? And there remains a good deal of uncertainty on tariffs by the Trump administration, as the Supreme Court could rule as soon as today on their legality. Zoom out, and you have a market priced for perfection, headed into a period where volatility could easily pick back up. But hey, I am open to counterpoints here, and maybe the Opening Bid Roundtable has some. Here with me is Innovator Capital Management Chief Investment Strategist Tim Urbanowicz and Yahoo Finance senior reporters Brooke, DiPalma, and Ines Ferre. Tim, good to see you. What did I get wrong here?
Brian, I don't think you got anything wrong. It's great to see you as well. When we're looking at this market, we think you're absolutely right that, overall the broad market is expensive, but that's really being driven by the large cap growth names in the index. And if you look over the last 3 years, and you know that we've been in the camp that we think large cap growth was going to drive the market, but it really was consensus that this rally was going to broaden out, and you hadn't seen it, okay? And we think that is really going to change this year, where you're going to see, the ex-Mag 7 names really start to pull their weight and pull this index higher, okay? What's been so unique about this cycle is with the AI buildout, it's really broken the typical economic cycle. Like, things in the economy hadn't been great, over the last couple of years. If you look at housing, you look at the unemployment rate continuing to tick higher. But right now, we're kind of in this Goldilocks environment where you've had the Fed that is cut interest rates. We have oil prices coming down, employment softening enough to justify those cuts, but not really bad. It's gone up at a slow tick. And really with that, we think those are catalysts to get a lot of those cyclical names back in the game and start and help carry that index forward.
Tim, I've been hearing from a lot of folks that it is a good thing that we're seeing the rally broadening out to other stocks. But, I would push back on that a little bit. And maybe there's a view that the Mag 7 is overvalued and people don't even know what to do with them. And maybe that's why they're searching for gains elsewhere in the market. I mean, I'm trying to say, I guess, it's not that great of a signal in my view.
Well, Brian, we would agree. I think those stocks are, to your point, priced to perfection. We anticipate that you're going to see those valuations coming down, a lot of that driven by better earnings growth. But really, when we're looking at this market, we want to find areas where there's room to surprise to the upside, where expectations are not so high. Everybody thinks Mag 7, this AI trade is going to continue. We think there's a lot of catalyst for that, but again, everybody expects it. So it's not something we would anticipate big gains coming from. Whereas other pockets of the market, we look at some cyclical names, financials, materials, industrials, those are areas that we think have the ability to really surprise to the upside, because there's not all that good news priced in. They're not trading at ridiculous valuations. In fact, they're cheap.
Ines Ferre, hit me with some Mag 7 analysis. What do you got?
Yeah, if we just take a look at the Mag 7 year to date, you will see that there's a bit of a divergence going on. I'm going to pull up the Wi-Fi Interactive so you can see that divergence that we're seeing. You're looking at Google Alphabet that is up more than 4%, continuing with that trade really from last year, where you saw Google outperforming the rest of the Mag 7. That's because of their TPUs, Google Gemini. But then you're looking at a little bit of weakness with NVIDIA. Look, China is a gravy on top when it comes to their their H200 chips, but still China, it's unclear whether they really want their tech companies to be buying. But look at this, Amazon up more than 5%. You've got the street that is looking for an upside with Amazon this year, which was more sluggish compared to the Mag 7 last year. And then you've got Tesla that is down more than 3%. I do want to also just point out in the software space, we have seen, I'm pulling up a 1 month, here's a 2 month chart. Look at Oracle, that weakness that we've seen with Oracle. And then just finally, if I'm pulling up the sector action here year to date, you can see, just as Tim was talking about, industrials, energy, materials, consumer discretionary, these have been the leaders so far in recent days.
It is more like snorkel. I'm just making these things up in real time. None of this stuff is in the teleprompter. Brooke, one name that has caught my attention in this Mag 7, it is Apple. And I'm going to double click. That's me double clicking. What in the world's going on with Apple here?
Well, as Ines just pointed out, that is one of the laggards to kick off 2026. And Apple continues to try to get into this AI game, and it seems like they just can't keep a hold here. And that's the story that we heard in 2025, and it seems like it's the ghost moving into 2026. There's a few key reasons here. Not only that AI strategy, but also what its competitors like Google, we've seen the year-to-date run there, what it's doing, and also these executive departures. And keeping in mind, if you do still look at the YF Interactive, what we are seeing there is this market cap for Google continue, or rather surpass for the first time during Wednesday's trading session, that of Apple. Keep in mind, Apple had crossed $4 trillion earlier this year because of the fact that they had that record strong iPhone sales. And now they're falling behind Google because of that key Gemini launch that has done really, really well for Google. Also, it seems like everything they do is just working right now in this environment. You have those executive departures at Apple that's also hitting the company. The COO left, or rather is retiring. The head of government affairs is retiring. General counsel, AI chief retiring over at Apple. And then on top of that, you have their design vice president who went to Meta. And all in the background, you also have Tim Cook, who is supposedly training the next executive to take the helm early 2026, as soon as earlier this year. And then on top of that, too, once again, that AI strategy continues to lag behind the other competitors, especially Google. And even though product has always done well for Apple, they seem to be supposedly launching this foldable phone this year. Their Siri, the AI strategy within their Siri product, just doesn't seem to be what the market wants right now. And so those three key things, AI strategy, executive departures, and competitors, is what's really hitting Apple yet again in the early innings of 2026.
Tim, I can't think of anything I would want less than a foldable iPhone. I don't want a foldable iPhone, but nonetheless, are you a buyer in this Apple weakness?
Well, Brian, I think one of the issues that we've seen with Apple over the last couple of years is product innovation, and their competitors have been really outpacing them in a pretty big way, in these different areas. We view Apple as a high-quality stock, obviously something long-term that we think makes sense in the portfolio, not something that we necessarily think is a big risk. But when we look at some of the growth opportunities, I think that, it's trading down at the level it is for a reason. You
think we're likely, Tim, to stay in this period of AI fatigue?
It's interesting, Brian. I think what we're going to see is really this trade shifting, right? It's been all about the hyperscalers. Now we think that trade is really going to roll downhill, which is another reason why we really see this trade broadening out beyond the Mag 7, really starting to see some of those AI-enabled revenues, margin growth. We think it's going to roll downhill. Again, not to say that we see some big sell-off coming in these hyperscalers. They're just expensive, right? They're expensive, so we're looking for other pockets of value, that next layer that's set to benefit from the AI trade, which we don't necessarily see as those top names in the index.
And as what bothers me a little bit about the Mag 7 trade this week, we had that big Jensen speech at CES on Monday. Fabulous leather alligator jacket by Jensen. Maybe it was a Tom Ford, whatever it was. He looked great. Lisa Su sounded great. Even Intel CEO had good things to say. We're seeing robot photos out there on X, people taking videos of stuff. Clearly, it's an exciting time in tech. And if these things are not going to send these stocks higher, I don't know what will in the short term.
No, I mean, it is definitely exciting when you're talking about those robots, autonomous driving and such. Look, I mean, we have seen this bit of a rotation happening, but it's not like it's falling off a cliff right now. And to Tim's point about broadening out the trade, I mean, yes, so we're seeing that broadening out with everything that is sort of adjacent to the AI trade, that being energy, that being electricity, the upgrade of the grid, industrials, but also I would point out that one of the trades that we have been hearing more and more about is also companies that are headcount heavy and the productivity gains that these companies will see in the next year or two. So you are looking at consulting companies, IT consulting. This is the trade that I'm hearing more and more about from strategists that are looking for productivity in the companies from AI, and this is where they are seeing some potential gains this year.
Tim, last word to you. How concerned are you about these stagnant labor market reports? This is not a one-time happening. This has been pretty much happening the past 6 months.
Yeah, Brian, well, right now, again, we still think you're kind of in that Goldilocks labor market where you can still justify what the Fed has done. You're not going to see them moving higher, potentially even moving rates lower. But we see risks on both sides of that. And, if we do see this economic upswing, if it does go too far, I think one of the biggest risks to this market is that you do see the 10-year yield moving higher. And that doesn't even have to deal with inflation necessarily, Brian, but just the labor market improving to the point where you start to see those longer-term bond yields go up. And then on the other side of that, if we start to weaken too much, and this is also one of the threats that we see to our outlook for this year, is kind of what we term as like the dark side of AI. If you start to see labor markets really, or jobs starting to be replaced by AI in a major way, we think that becomes problematic if you do see the unemployment rate spike up higher. We are watching that closely. If you look at the recently announced mass layoffs toward the tail end of last year, we're estimating about 15 to 20% of those had something to do with AI. So that's still contained, but we want to watch really the risks on both sides. Labor market weakening too quickly or strengthening too fast.
I take that back. Brooke, last word to you. One area where I think you're seeing some of this AI job taking is in the retail space. Not exactly a great month for retail in that jobs report.
Well, Walmart certainly has been vocal about this. Walmart saying that AI boosts productivity at the company, but falling short of saying that they're going to directly impact job numbers, just how much the sheer force of their workforce. America's biggest retailer, they were short to say that they're going to lay off jobs because of AI, but definitely did say that they boost productivity. Also worth noting that on Thursday morning, Walmart did announce that they're adding a board of director member who has a background in AI. And many experts, many sources that I've spoken to on the street have told me that this is really a sector that needs to advance, needs to move with this change. And that change is how technology is going to play a role into this very traditional old school sector that is retail, that has been changing over the past decade and now is changing even quicker.
All right, big thanks to my opening bid roundtable. Appreciate it. Have a great weekend, y'all. Coming up, I'm digging into the shining safe haven trade. That's next on Opening Bid. It has been quite a 12 months for physical assets. Gold is at record prices. Silver prices are also at a record. Copper prices, you guessed it, also at a record. Costco can't keep gold bars in stock. Shares of publicly traded pawn shop Easy Corp are up to 80% in the past year. They have a lot of gold for sale there. The U.S. government has officially ended penny production due to the high cost. Put all this together, and 2026 could be equally as exciting for physical assets. My Power Player guest knows a thing or two about this topic. Philip Diehl is the president of gold vendor U.S. Money Reserve. Earlier in his career, he was the 35th director of the U.S. Mint, where he was a key player in the 50 States Quarter Project and also the Sacagawea dollar coin. Philip, so great to see you here on this Friday morning. I mean, I guess the million-dollar question is, no pun intended, how much more upside could there be in gold, and what would be the drivers of that upside?
Well, my forecast is that we're going to see $5,000 an ounce this year. We may see it as early as June. And that seems pretty aggressive. But when you look back over the track record of gold just for the last 6 months, that is very reasonable if we continue those rates. This gold market rally began about 2 years, 4 months ago with the attack on Israel by Hamas. And here today, we have seen the attack and military action in Venezuela again drive prices up about $100 an ounce immediately upon that military action, and then some rallying since then. I really have my eye on uh, three or four factors. One is I think the administration is aiming for oil prices at around $50 a barrel this year. And the purpose for that is to drive down prices at the pump, to drive down inflation rate, and thereby giving a green light to the Federal Reserve to lower interest rates. I think that's crucial to the administration's economic political agenda. The second thing I'm looking for is the impact of AI on employment and on jobs and job growth. So those are the big factors that I think are going to be driving gold this year.
Philip, when you talk to investors or consumers, whoever it is, how are they buying gold right now? Is it that Costco gold bar? Are they buying coins? Like, how are they building out their physical asset portfolio?
Yeah, the Costco purchase has been a big deal, and the fact that you led with that is an indication. I've been asked whether or not we consider that to be a positive or negative for us. I think that's really a positive for us because what Costco is doing is giving its seal of approval on gold as an investment asset. And that's good for all of us in the industry. Costco is selling very low quantities, and they're often running out. Whereas we sell much larger quantities and we don't run out, and we are sort of selling to a different market.
Do you think that's the best way to gain gold exposure? Head over to your Costco if you're a member, buy that gold bar, or is it a coin, or is it even a gold ETF?
No, well, it depends on what your objective is. The gold ETFs have created for people who need flexibility, need liquidity in their assets. Those are traders. The people who buy physical gold are those who buy and hold. They buy it for certainly for appreciation value, and we've seen that. Really, gold has outperformed the S&P 500 not only over the last 2 years, but out of the last 10 years, and over the entire last 25 years, and that includes the reinvestment of dividends. So gold is not just a bad news investment, and people are beginning to wake up to that. But they are also buying it for the traditional hedge and portfolio protection reasons.
Philip, this is the first time we're talking to you post the government stopping the manufacture of pennies. What did you think of that move, and what's the longer term ramification of us possibly moving away from physical money?
Well, I was probably the first Mint director 30 so years ago who advocated the elimination of the penny. The penny is a disposable coin, has been for decades, and it just didn't make sense. It had no real utility in American commerce. I applaud the administration for doing away with it. I think it's a savings for the government, not a big savings, but it doesn't hurt. And so in terms of physical money, I think, physical money has been around for about, I don't know, 4,000 years. I don't think it's going to go away. The convenience and the privacy of physical money and handling transactions, I think, will always be an attraction.
Do you think what could be the next coin to disappear, and why?
It'd be the nickel. The nickel continues to be unprofitable for the government to produce, and there are some things that we could do in order to make it less unprofitable. It would still remain unprofitable, but we could move to a change in the composition of the nickel to, for example, steel, and that would help.
When you hear folks, Philip, say that cryptocurrencies are competing for investors with commodities, what do you think?
I don't think it's credible at all. I sort of laugh at the idea that it competes with gold as a store of value. When you lose 30% of the value of an asset within a matter of months, that's not a store of value. Gold has this track record of being a store of value, a reliable store of value that dates back 3,000 or 4,000 years. And crypto just simply can't compete with that.
One last question, Phil, before I let you go. How is your commodities portfolio? How are you invested?
Well, mine is about 20% into gold. And it's been good to see some of the big players in the industry just in the last 6 months begin to revise their portfolio recommendations. The CIO of Morgan Stanley last fall revised his recommendation for portfolios from 60 stocks, 40% bonds to 60% stocks, 20% bonds, and 20% gold. And we're seeing those allocations to gold increasing to anywhere from 15% to 25%. It depends on how pessimistic you are about the state of the economy, the state of the world. People who are more pessimistic tend to seek that protection in gold.
Philip, we need to have you back. I could talk about this stuff all day. Philip Diehl, have a great weekend. We'll talk to you soon.
Thank you.
Appreciate it. A little note from me ahead of the weekend on Monday at 8 a.m. Eastern Standard Time. A new episode of my Opening Bid Unfiltered podcast drops. I sat down with one of the biggest players in deal making today, Perella Weinberg CEO Andrew Bednar. Trust me, you will not want to miss this 30-minute masterclass on deal making and investing. You can watch live on Yahoo Finance and YouTube, or listen in on Spotify, Apple Music, Amazon, and even iHeartRadio. Straight ahead, U.S. Labor Secretary Lori Chavez-DeRemer joins us for the administration's take on the jobs report. We'll be right back.